But let's get big to the bigger story, which is around the central bank governor and what he said at the bankers' dinner. Nigeria's new central bank governor Olayemi Cardoso outlines his new policy direction for the central bank as well as the financial regulator on the economy. That was on Friday. The new central bank governor, of course, spoke about a return to 100% orthodox monetary policy, inflation targeting, single interest rate regime, exchange rate realignment, as well as banking sector recapitalization. So the question, what will this new direction mean for Nigeria's securities and investment market? Let me show you at this point very quickly what the commercial partners said today in a statement which was released to the market about their comments on what this CBN roadmap would look like. What the central bank governor said was that there'll be a fresh round of banking recapitalization. Everybody took that away. What are the opportunity analysis, according to Commercial Partners, which is a licensed investment firm, that this planned recapitalization could lead to increased activity in the capital market, and that's an opportunity for financial advisory firms. Let's go to the next point. That's about the expected high interest rate until second half of 2024, and Cardoso outlined his strategy to use monetary policy instruments to curb inflation, stabilize the FX market. The idea is to maintain high interest rates until the second half of next year. What does that mean? Investors may find higher interest rates in debt instruments like commercial papers more attractive in the first half of next year compared to the second half of next year. That's what Commercial Partners said. I'm going to take you to the third point. What's the update on CBN Liquidity Management Committee? Well, the central bank governor said Friday that there's a new liquidity management committee that meets 8 a.m. every day to assess liquidity in the market and ensure you have an optimum levels. Cardoso noted the positive impact of that so far and said that could have significant reduction in excess liquidity and an uptick in overnight bank borrowing, which we report to you today above 20%. Got opportunity analysis. There is improved liquidity conditions present an opportunity for financial institutions to engage in strategic financial planning, take advantage of evolving monetary policy landscape, and the central bank itself could also position itself to benefit from that. What was the final point? Is the update on liquidity management, and that's the third point there. You've just explained that to you. That's what Commercial Partners brought to the table as far as the analysis of the central bank's new roadmap under Olayemi Cardoso. Now let's dig deeper as we bring on Johnson Chukwu, who is a market professional and group CEO at Cowrie Asset Management. Good evening to you, sir, and thank you for connecting in tonight on the show.
Good evening, thank you for having me.
We appreciate making the time connecting to the show. What's your key takeaway? Let's start from there, from Cardoso's speech on Friday evening.
I think there are two major key takeaways. One is there is a clear intention of the central bank to further recapitalize the banks. Two, the central bank has said that they are going to adopt only orthodox monetary policy in managing the economy. And they are going to do away with the quasi-expansionary fiscal policies of the previous central bank administration. So for me, those are the two critical defining components of the speech made by the central bank governor.
Yeah, that's what everybody heard. I'm trying to find out what's in the governor's speech for you as an investment banking and securities market professional.
Well, for us as an investment banking firm, the banking system will go to another round of recapitalization, means that it creates an opportunity for us to help many of these banks to raise additional capital. We're currently working on a number of banks where we're acting as issue house and or something, in some instances, financial underwriters. So we expect more banks to come to the market and raise additional capital, and that creates opportunities for us. At the macro level, it also means that, one, we need to look at the return threshold or the return, expected returns from banks, investment in banking stocks, if they have to compel to raise additional capital. The intention of the central bank governor is that the banks will have sufficient capital to finance a $1 trillion GDP. But we also must take that in with some level of circumspect. in the sense that the economy today is just about $400 billion. And if you go by the government projections, a $1 trillion economy is not feasible in the next 7 years. So what we may be looking at is that, which I had to make reference to, the expected returns that we should expect from banks, should they be compared to further increase their regulatory capital. If you take, for instance, the medium-term expenditure framework, 2024, the economy is supposed to grow about 3.76%, to grow by about 4.22% in 2025, and have about 4.76% in 2026. So if you take that, if you take an average growth rate of about 4% or 4.5%, you're not going to see an economy at 400 billion attain a 1 trillion naira in the next 20 years. I mean, to $1 trillion in the next 20 years. So we need to also, in trying to get further, the need for banks to raise additional regulatory capital. If we're going to go by the projection of the government, so maybe the government will also have to review their projection. You need to grow the economy at about more than 10% to attain a $1 trillion economy in the next 10 to 15 years. But at 4%, it's not possible.
Yeah, Johnson, we're going to come back to the recapitalization a little bit later in this conversation. I just want to get your thoughts around the governor's speech as far as investment banking and securities market. What do you think of this return, 100% return to full orthodox monetary policy regime? What will it mean for the financial markets outside the banking sector?
I think we should expect some level of macroeconomic stability in terms of price stability. Some of the challenges we had in the past is the unorthodox expansionary measure that the central bank used. One, funding of virtually every sector of the economy, playing the roles of the fiscal authorities, and also lending to the federal government without any restriction, without abiding by the extant laws and regulations. So if we pull back from that, we should expect a reasonable level of liquidity. We should expect an investment environment where return on fixed income instruments are higher than inflation rates. Maybe not in the immediate, but in the medium term. We should expect that the return on fixed income instruments, we've already seen yield on OMO trade around 20% effective yields. And the last two auctions of treasury bills were at 16.75%. Which, because it's a discount instrument, if you analyze that, you will get an effective yield of more than 17.5%. So we are moving towards an environment which is what you should have in any investment environment, where return on money market instruments, particularly 364-day instruments, mirror are at least higher than the inflation rate. And that will also help us moderate inflation. Like I said, should expect some level of price stability. If you exercise the economy of excess liquidity coming from central bank liquidity injection, we shouldn't have the kind of inflationary pressure we're currently facing.
Interesting. So that takes me to the what you think the forward future inflation and interest rate outlook will be, and what would it mean for the securities market? You're just touching on how it will impact on fixed income. But again, on the equity side, when you have interest rate of a new direction, you have inflation targeting by the central bank. Do you think these two could work together for a much bigger, much deeper liquid securities market, at least maybe not in the first half, maybe second half of next year or beyond?
Yeah, maybe much later than the second half of next year. If this is done, and the fiscal authority, because it has to be, there has to be a handshake, a proper handshake between the monetary authority and the fiscal authorities. If the fiscal authority also does their own bit of the job, which means we don't have an overly expansionary fiscal tool or fiscal policy. And then it will be easier for the inflation targeting to be reasonably achievable. Remember, we've done this inflation targeting for the past 20 years. It didn't just start from Cardoso. I know during Soludo's time, we talked about inflation targeting. We talked about that under Sanusi. And then even the immediate past, central bank governor also made reference to inflation targeting, which we observed in breach. So you need to have the fiscal authority and the monetary authorities working hand in hand in the same direction for inflation targeting to be effective.
Okay, so let's get to this all issue about this capitalization, which he hinted about. The central bank governor did not state exactly what the size will be. When Soludo did a similar exercise back in 2004, from the first day he mentioned, he gave the figure of 25 billion naira. So do you think Cardoso is still consulting or is keeping his cards close to his chest? What do you think of that? What do you make of it?
I think what I would say is that he should still be consulting. I want to believe that he should still be consulting. There are a lot of gray areas he needs to address. One, you are talking of regulatory capital. You also have to look at operating capital. As it relates to operating capital, many banks will maintain an operating capital is sufficient to meet their foreign activities. But in terms of regulatory capital, given where most of the banks are, a regulatory capital that surpasses the current operating capital of the banks will be a tall call. Many of the banks, the top 5 banks, have shareholders fund in excess of 1.5 trillion naira. So are you going to increase the share capital of a bank above 1.5 trillion naira? If you look at the second tier banks, you have shareholders funds around 500 billion. Are you going to increase above 500 billion? Then you have some marginal players and the new banks. Maybe they're the ones that will be affected. But what I was referring to, which it's why I said he has to consult further, is that a $1 trillion economy is not at the corner. It's not around the corner. And the banks are building their capital in tandem with the growth in the economy, with the size of the economy. So if you now front load a capital-based requirement for $1 trillion GDP, without the economy getting to that in the next 10 years, what will happen is that investors in the equities of banks will get returns that are far below what they would have gotten elsewhere, because the bank will not be able to deploy those additional capital in funding economic activities if the economic activity has not expanded. And that's why I made reference to the projections in the medium-term expenditure framework. And if that is the basis the economy will be growing, then the economy will not see $1 trillion in the next 20 years. And in that case, if banks have to raise additional capital this year or next year to meet a 20-year time horizon for $1 trillion GDP, then what will be the kind of return they will get from that? And that's why I said he needs to further consult. We need to look at which banks have a compelling need to increase their capital, what level of new additional capital requirement do you want to specify, what do you want to set for regional banks, national banks, and international banks. But like I said, the international banks already have excessive capital for if you have to look at the local market. Of course, they are deploying that for the international operation as well.
Do you think if and when Cardoso finally finish consulting and all that, do you think there should be a deadline for the recapitalization program this time as we had back in 2004 under Soludo?
Can you come again with your question? I missed this first part of your question.
Yeah, I was asking when Cardoso is done consulting, do you think we should have, or you should give the banking sector a deadline? Remember, Soludo was 18 months. What timeline do you think should be set for the banks to recapitalize this time around?
Well, for every recapitalization target, there must be a timeline for conclusion. A 2-year timeline, the challenge we have to deal with when the economy will grow to that 1 trillion. Do we expect that if realistically the economy will be at 1 trillion in the next 7 years? The answer is no. Okay. If this is not so, do you want to give them a timeline to recapitalize in the next 1 year or 2 years? And if they do that, what will they use that capital to do? So I think we need to focus on operating capital. And that is where...
Let me ask you this. Let me join in. Let me jump in here. So, is there a need right now, today, Monday, November 27, 2023, for recapitalization of banks in Nigeria?
Let me give you a technical answer. There are some banks that are currently undercapitalized. There are even one or so bank that has negative shareholders funds. Which ordinarily the law should not permit. So if you look at it from that perspective, there is a need for the central bank to enforce the capital requirement of banks. That is not being fully enforced. So that's the starting point. Then, does the economy as a whole require additional capitalization from the banks? Are the banks currently not in positions to lend for the economic activities of business operators in the economy? The answer today is the banks have enough capital to lend to of business operators in the economy. The size of the bank's capital base is sufficient for the size of the economy today. But that does not mean that there are not a few banks that are not properly capitalized. So the emphasis, which is where I was heading to, the emphasis should be, one, enforce the existing regulatory capital. Two, also push the banks to make sure they meet operating capital requirements. And to measure operating capital requirements, you're looking at capital adequacy ratio. And you have already set a capital adequacy ratio of 10%, and then for local banks, and then for systemically important banks, you have set a capital adequacy ratio of 15%. So what the central bank could do is to increase the capital adequacy ratio to maybe 20% or 25%. And that will compel the banks to raise ordinarily operating capital that will meet their size of business, so that investors like you and I will continue to enjoy reasonable return on investment. Once a company is overcapitalized, the return on investment will be diluted unless that company has opportunities to invest in additional capital. If the economy has not expanded to 1 trillion, which is the premise on which the statement were made, then the capital requirement for 1 trillion may not be there now.
Well, interesting. Olayemi Cardoso fired a shot on Friday. Tonight, I'm sure you've seen the market report. You're the group CEO of Carry Asset. I'm sure you see the numbers per second wherever you are on the planet. So the banking sector today was up 1.7%. The shares of FBN Holdings, Sterling Bank, Access Corp, FCMB, UBA went up today. That's reacting to Friday's Cardoso's statement on banking sector capitalization.
Yes, both is interesting because of the level of knowledge within the economic space. I know a couple of people called me on Saturday and asked that with this recapitalization, then we should be talking of banking units of banking stocks trading in the region of 500 naira. I said, look, where are you getting that from? He said, no, if the banks have to capitalize further. And the guy argued, and he's a knowledgeable person in that field of human endeavor. And I tried to correct him. I said, look, the value of a stock is dependent on the future earnings capability or potential of that instrument. Yeah. So if the earnings potentials have increased by the announcement of the central bank governor, then I can justify why prices are rallying. Unless there's something I'm missing. If the banks recapitalize today and there is no expansion in their business operations, then there will be dilution in earnings, and the price of the stocks should ordinarily moderate down southwards. That is classical economic thinking.
Yeah, that's classical economic thinking, but it's not so, because folks had $1 trillion and recapitalization, and all the banking stocks spoke today. They just went up. Haywire. 132 billion naira today in total market value addition. You folks got a better Monday than myself. Look, are you guys, do you think investors are just happy that here comes another rally? This is 2004, 2005, and 6, and 7, all over again.
Yeah, that's what I was saying earlier, that some investors think, wow, with this recapitalization, then we should expect, so like I said, somebody said it will be 500 naira per share of any banking stock. And then they think they're taking positions ahead of that recapitalization. But that is a fallacious assumption, because the recapitalization, when it does happen, we also need to have increase in economic activities, increase in lending opportunities, that the banks can optimize those additional capital to generate further earnings that will enable them pay more dividend to shareholders.
We need to wrap this up. My final question. How do you think international investors will take or should take Cardoso's consolidation? Or how should they take it? International investors this time around. How do you think they should spin this on their minds looking at Nigeria's market?
But the truth is that international investors will do the analysis I've just done here. And they will ask themselves, This capital requirement is premised on a $1 trillion GDP. Would Nigeria attain $1 trillion GDP in 2030? The answer is not likely. Okay, if Nigeria will not attain $1 trillion in GDP and the bank, and you put more money to the banks and they have excess capital, what kind of return should you expect? So investors, international investors are quite savvy, and they will do this analysis I've just shared with us here. And again, the other factor they have to look at, whether the economy has become an investment destination. Hopefully we'll achieve that in the near future, but we're not there yet. We need to address the issue of FX liquidity. We need to address the issue of unmet trapped funds in the economy. Those two are simply none for you to have become attractive again to foreign investors. Those things must happen. And then you must have investment opportunity that are available for this additional capital that may be raised for investors, foreign investors to scrabble to buy those instruments.
Well, okay, the party has started already. Johnson Chukwu, join the party. The party has started, and it started today. It's Monday, by the way, so you got a whole lot of time during the week for the party to go on. Let's see what the market says tomorrow. Have a great evening. We appreciate your time on the show tonight. Thank you so much. I appreciate those perspectives. Johnson Chukwu, Group CEO at Carry Asset Management. That's it. Talking to us.